Well, first of all, we're nowhere near the bottom. Stock prices are inversely valued based on interest rates. So all else being equal, if interest rates go up, stock prices should come down. And in fact, that's what happened. And the same thing with bonds. Of course, we all know that if interest rates go up, then bond prices come down. They're the opposite of rates. And that's what happened. And of course, in fact, one of the reasons that they kept saying the stock market wasn't overvalued is they kept comparing it to the bond market, which was also overvalued. Well, now they're both coming down, and they both have a long way to fall. In fact, I think there's more risk in the bond market than there is in the stock market. And in an inflationary environment like the one that we're in and that we're going to be in for a long time, you want to own companies that are selling products and services that people need, and they will pay for. They will continue to buy even if the price goes up. They will give up other things in order to keep buying what you're selling. And to the extent that they have to cut back on how much they buy, they're still going to buy something, even if they buy less. Whereas there are a lot of companies that are selling products that people only buy after they buy all the things they need. Then, if they have any money left over, they buy these other things that they want. You don't want to own the companies that sell those things because they could lose their entire business. People just give up. They don't have any money left over. After you pay your rent, after you pay your electricity, after you buy the food, pay your insurance, pay your taxes, pay all the things you have to do. If there's nothing left over, well, there's nothing left over. And if you can't go out and borrow it anymore, there's no credit floating around anymore because everything is tightening up, well, a lot of these companies are going away. So you want to own companies that have pricing power. But also, in an inflationary time period, you want to own companies because they own real assets. They have resources, they have plant and equipment, they have things that have value that will hold value even as paper claims are losing value. So I'd rather own equity in the company than be a bondholder, because what inflation ends up doing is it ends up transferring wealth from creditors to debtors. So I'd rather own the company than the bonds of the company, which are going to be eroding away in value because of inflation. I saw this train wreck coming from a mile away. My problem is I saw it too clearly and I saw it too early. But at least I saw it, because most people still have no idea what's coming. They're going to die in this wreck. I'm all buckled up and ready to go. So I own value stocks. I own dividend paying stocks. And, they've outperformed dramatically this year and over the last several years. I still have ground to cover to catch up to the S&P, but I'm quickly, catching up. And I think maybe by the end of next year, I'll surpass it over a longer time period, because air is, quickly coming out of the bubble. And I think there's going to be a gaping hole in that bubble next year. So a lot more air is going to come out. But I own non-US stocks, mainly because I think the dollar is going to weaken. I think we have a lot of political uncertainty here as a result of how the government is going to react to how bad the economy is going to be. So I'm worried about regulation and taxation. So I think it's less political risk in the countries I'm investing in abroad. Much better valuations. The stocks are much cheaper. The dividend yields are much higher. And I'm getting revenue in foreign currencies. I own a lot of resources. Energy, which has done very well, obviously, this year. But I've been in energy for a while. But also minerals, agriculture, emerging markets, which I think are very cheap right now on a relative basis compared to the developed markets. So I think those stocks are going to do very well in an inflationary decade with a weak dollar. We have a lot of positions in Southeast Asia, in Western Europe, some in South America, Australia, New Zealand. We're around, in North America, we have some investments in Canada, and we have a good exposure to gold. And I am very bullish. Obviously I've been bullish for a while, but I'm even more bullish now to the extent that that's possible based on what's been happening. But, I do expect significantly higher gold prices, silver prices. These stocks are very cheap. They're probably as cheap as they've been, both in absolute and relative terms. They're so under-owned. Nobody in the institutional community really has any kind of position in this sector. I think by the end of the decade, they'll all have positions in this sector. But of course, the stocks are going to be much more expensive at that point. So don't wait for the crowd to figure it out. And I've been there for a while. It's been kind of lonely, waiting for the crowd. But there's a few more people now showing up. But it's going to be a hell of a party, I think, by the end of the decade. Gold moves in big cycles. I think this bull market really started in 2001. So, we're 20 years into it. But we had a pretty big correction from 2011, to 2015. That's when we bottomed out. We've been moving up since then, but we haven't really taken out the highs from 2011. We got above that high in 2020, but not all we've done is really set up a double top. And I think we're going to take that out. And then that double top is going to be the new floor. And there was also, a sideshow going on in Bitcoin. Stole a gold spotlight for a while because, while gold was going nowhere, Bitcoin went from nowhere, to 60,000, 70,000 a Bitcoin, right? And everybody who got involved in this, on paper anyway, they all were rich. And some of them actually got rich because they cashed out and they sold Bitcoin and they bought real things with it. So there are people that got in early, that got out and got rich. I think to some degree, people that were frustrated gold bugs got into Bitcoin, because Bitcoin was performing, right? It was going up while gold was going sideways. But Bitcoin was marketed as digital gold. That was a whole selling point. Hey, gold is obsolete. Gold is irrelevant. You got Bitcoin. But meanwhile, the smart money was buying gold the whole time that everybody was talking about Bitcoin. It was the dumb money that was being suckered in to Bitcoin. But I think that now that the Bitcoin bubble has popped, and over the next several years, the air is going to be coming out, nobody is going to be comparing Bitcoin to gold. Nobody is going to be talking about it as digital gold, as a safe store of value, as an inflation hedge. Everybody has pretty much come to the conclusion that it's a speculative asset. The problem is, what exactly are you speculating on? Because there's no value there. So if it's not digital gold, what is it? It's nothing. There's no value. Even when Bitcoin is down 95%, 99%, I still wouldn't buy it. So I don't think we need more regulation. We actually need less regulation. We didn't even have the SEC until 1932. The New York Stock Exchange started in 1792. So we had 140 years of no SEC. I think we had a much better market, more efficient. I think there was less fraud back then than there is now. More regulation is going to hurt the industry. It's not going to help the industry because the whole selling point of crypto was its lack of regulation. That was like why it existed. If you think of Bitcoin as like a pyramid scheme, and a couple of years ago, a lot of these retail investors had got in, and now they needed more buyers. And they were trying to entice the institutions to come in because they had the big firepower. And so in order to make it marketable to the institutions, that's when they started talking about, we need regulation. But I think now, given that there was a big collapse, because the whole institutional interest was all the FOMO. Like, hey, look at this thing. It's the best performing asset. You got to get in on it. If you don't get in, you're going to miss out. So I don't think the institutional demand is going to be there anyway. So I don't think no matter how much regulation you get, the institutions aren't going to want in, but the individuals are going to want out. It's going to keep coming down. Now, people still want to make fun of me and say, well, Peter, if you'd have bought it 10 years ago, you're still ahead. Yes, okay, but most people bought it a year ago, 2 years ago, 3 years ago. They're way behind. And in another couple of years, even the people that bought it 10 years ago will be losing money.